What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. I am joined today by Hari Krishnan and Ash Bennington. Ash is the senior editor and crypto editor at Real Vision, and Hari is the head of volatility strategies at SCT Capital. They're both here to talk about a book that they've co-authored, which takes many of the lessons of Hari's last book, The Second Leg Down, and incorporates them into a practical framework for dealing with credit, positioning, and liquidity risks that investors face in modern markets. You can access the transcript and intelligence report to this episode through the Hidden Forces website, where you can also become a premium subscriber today. Since this episode deals with markets and investing, I want to make it absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, I bring you my conversation with Hari Krishnan and Ash Bennington. Ash and Hari, it's great having you both on the podcast. Hari, you were on the podcast back in spring of 2020 for what was a really awesome episode. I learned so much in preparing for that, and I remember that people really loved it. And Ash, we are good friends, you and I. We've known each other for several years now. I've actually known both of you guys for several years, so I'm really excited to have this conversation. This is a continuation, it seems, or maybe not a continuation, but a book, your latest book, Market Tremors, is a book that builds on your last book, Hari, The Second Leg Down, and you guys have co-authored this book together. What is the nature of your authorship, and what is the nature of this book in terms of its relationship to The Second Leg Down?
Well, if you'd like, I can deal with that one. First of all, thanks, Demetri, for having me back on. It's a pleasure. I gained a lot from the first one. Well, I had a business imperative, and the business imperative was this. I run mandates as a hedger and as a thematic macro investor for clients. And for the first book, the idea was most people don't like to hedge in quiet markets, and then they desperately scramble for protection when risk elevates, when volatility goes up. So what can they do that isn't too bad? But there was a long period, let's say, from post-global financial crisis, from, say, 2009 to 2019, where volatility was really low. And it was caused by a variety of factors. And I wanted to keep the business imperative going because I believe there was a lot of risk underneath the surface. And Market Tremors is basically a dissection of the factors that have driven this kind of suppressed volatility regime in interest rates and even in equities, at least until the 9 to the present, where interest rates were artificially suppressed and even equity volatility was low, at least until the past year or two.
Mm-hmm. Right. So the environment that we're in today, although when we recorded our last conversation, we did have that rapid correction in markets, but overall we were living in an environment that was still characterized by the sort of post-2008 period. What do you guys think has happened to the market or to our conception of the market based on what we thought we knew about it pre-2008?
Well, the risk takers have changed. The risk takers, to some extent, or maybe even to a large extent, used to be in banks. Then they moved off into hedge funds and various other places. And what's happened is that banks and traditional intermediaries are unwilling to take risk. They're not allowed to, perhaps, post-Dodd-Frank, or they don't want to, for balance sheet considerations. And so other people are coming into play, whether it's high frequency traders or whatever. And that's created more fragility in the market because there's less absorption if there are multiple sellers into a market or big sellers into a market than there used to be.
Well, first of all, thanks for having me, Demetri. So I've known Hari for a number of years. I actually interviewed him over at Real Vision for The Second Leg Down, and I was really intrigued by what he was working on, the way that he was thinking about risk, volatility, and how to hedge against challenges after volatility had begun to rise in markets, I thought was really compelling. But to get back to the earlier question about what's changed, I think that two of the main points that Harry had been thinking about, and when I came on board on the project, I should say, first of all, in all humility, that Harry is the one who engineered all of the math. This was just something that I was incredibly interested in, and I was excited for the opportunity to work with him. But I think that, the two market setup things that are really important to understand are the rise in debt, kind of across the board, in public debt, private debt, and held by sovereign nations, held at the state and municipal level, and also the amount of debt that's increased on balance sheets of corporations. And the second point that I think is important to understand is the nature of central bank policy. Since the 2008 period, we have been at or near the zero bound on the federal funds rate here in the United States for most of the time. We had a little bit of a leg up where we attempted to normalize in the pre-COVID phase, but that was relatively short-lived. So understanding, I think, the backdrop, the setup, increased levels of debt, and artificially suppressed interest rates by central banks around the world are probably the two most significant changes that we've seen to the overall structure of markets since the 2007-2008 period.
How do you guys think about the role of investor psychology and sort of the behavioral conditioning of market participants that has occurred? Because that's a difficult thing to quantify, right? So how do you think about that with respect to, leverage and positioning, which, certainly Ash's response speaks to the leverage part, if not the positioning as well?
There's the notion of the Fed put, right? That the Fed will bail out all risky assets, not only long duration treasuries, but also credit and equities, if things get bad enough. And I think that notion has perhaps led to excessive risk taking in many markets.
And the central bank in this case, and we're going to get into this when we talk about the model that you've developed, but the central bank would be a dominant agent in this case, correct?
Yeah, the basic thesis is that, we didn't want to trash the classical models of finance, which basically say that there are a bunch of agents in a network, they buy and sell. They make transactions, they're lenders, they're borrowers, they're investors, and so on. And their transactions largely average out. So whatever returns you observed in the past are pretty good proxy for the future. We don't say that's totally false. What we do say is that when certain agents get very large, when they become whales or dominant agents, as you said, they can distort forward returns. So if someone has to liquidate an S&P position, to pick a random example, 50 points below where we're at now in size, that's going to change the distribution because the impact of their liquidation will cause mega price moves. And that's what we try to incorporate in our analysis.
Ash, you have anything to say there?
Yeah, I think that's exactly right. Thinking about this as kind of a network model with dominant agents gives the ability to potentially understand or describe certain market phenomena that the traditional, for example, risk metrics may not capture very elegantly.
All right. So I think now that we've kind of set up where we're going, I think it would be helpful to sort of take a step back and get a sense of what the sort of financial models are that investors work with today and what some of those assumptions are that underlie those models. So what are the assumptions that underlie the standard models used in finance today?
Well, let's start with Markowitz and end with Taleb. Maybe that's the right paradigm. Markowitz says that, not that it's a bad approximation, at least it's a first approximation, that, or at least the efficient markets hypothesis type stuff suggests that most assets have fairly normal distributions. They evolve pretty randomly. And if you can manage the covariance structure, if you can manage the interaction between various assets in a good way, then you can build portfolios that are more efficient than otherwise.
Explain covariances.
How a couple of assets move together. Classic example is bonds versus stocks. So take 10-year treasury notes versus the S&P. They've not always been negatively correlated. In fact, over the long term, they've had a positive, mildly positive historical correlation. But the fact that they both have positive returns and they don't move together makes them a good mix. And so portfolio theory was founded on that mix, which is based on the idea that if you can find two assets that deliver decent returns or even non-zero returns, but don't move together, that's a nice portfolio to have.
Yeah, I think that's exactly right foundationally in terms of understanding the way that that professionals think about markets. I would also say, well, that's obviously, Harry is clearly an institutional financial professional and thinks about this at a very sophisticated level. But I think that most people sort of intuitively sort of work within that framework. You hear about, until quite recently, the 60-40 portfolio with bonds and equities. You hear about things like diversification. That all comes out of Markowitz, as Harry just pointed out.
So what's the problem with these models? I mean, people have been using them for decades. What do you guys feel is lacking that you wanted to address with your work, Hari?
Well, my feeling, and I don't say this is exact, but it's my impression I think is correct, is that there was either the academic ivory tower model or there was the black swan model, which is that whatever you do, you're going to get blindsided with an event out of the blue unless you stay in T-bills and highly risky convex bets, which is kind of what Taleb was focusing on. And I think it really pushed the discussion forward. But for me, I wanted to take a lot of those black swans and push them back into the gray swan category, which is not common, but not that rare. And the goal there was to say, well, can we take extreme moves and actually say something meaningful about them in a numerical way?
So kind of like going from chaos to manageable complexity, something that you can wrap your arms around that still says something interesting and representative about the market.
Yeah, I mean, if you adjust the average return size based on the horizon, so if you look at 1 minute returns versus 1 hour returns versus 1 day returns versus 1 week returns and so on, for something like the S&P 500, which we focused on a lot in the book, you'll find that there are a lot of 6 standard deviation events, like highly rare events over 1 minute horizons. There are liquidations that occur all the time, but over longer horizons, they occur less often. So clearly the standard models fail over the short term. But what happens over the short term? People have big positions and every now and again they have to dump them. Maybe they get a margin call. Maybe they hit their risk limits. Maybe they have an internal stop loss. All of that drives extreme looking moves that really aren't that extreme if you know who the players are in the market.
Yeah, and it's something that when you look at the microstructure of those shorter term time horizons, as Harry said, sort of contradicts this notion of smooth, regular returns that occur with harmonized level or average level of variability.
So guys, one of the things that I think I've always thought is interesting is how most people associate market moves with some tangible news that they've consumed. And that's oftentimes by design. It's what sort of journalists will do. They'll ascribe meaning to something that could otherwise be meaningless. And that speaks to the distinction between exogenous factors and endogenous factors driving markets. And one of the things that I really enjoyed about my last conversation with Hari and that you guys get into in the book is sort of breaking down the main drivers of endogenous moves. So first of all, what is the distinction between these two? How important are endogenous factors? And then when it comes to endogenous drivers of market movement, what are the most important variables to look at?
Okay, well, let's go back to the whole timescale thing. Over short horizons, various people, including Jean-Philippe Bouchot, have shown that endogenous factors dominate. So basically what they did was they tried to tag large price moves to, say, a Bloomberg news feed or a Reuters news feed or something like that. And they found that most of the big moves didn't occur synchronously with that. So how did they occur? Well, it must have been something in the network. And so over short horizons in the microstructure, as Ash said, space, it's well known that network risk dominates, at least in terms of frequency, for large moves.
And by network risk, you're talking about, again, you're speaking to the endogenous forces.
Yeah. Basically, stuff happens in the outside world. There are wars. There are even things like earnings reports are quasi-external. And there are various other things that happen, in the world. And those are considered exogenous events. They're new pieces of information that are brought to bear on the financial network that lead them to buy or sell things. In the classical models, that's all that matters. Everything is priced fairly until a piece of news comes in, and then prices adjust. What we're arguing, and it's not just us, I mentioned Jean-Philippe Bouchot there, Doan Farmer and others, have shown that a lot of the price movement is actually driven by repositioning. It's flow driven. You may have heard, a lot of the audience will have heard that flows are driving markets, and they may look quizzically at that, but it really is who has dollars to buy, who has dollars to sell, where do the dollars come from? Do they come from the central bank? Is the central bank creating enough money so that there's more demand created synthetically through dollars to buy or whatever? That really has a bigger impact on markets than just news events that are reported upon by the press.
Well, so I'm going to have a follow-up question there. Before I do, though, I want to draw a parallel maybe that could help listeners. Is a good example of this like traffic on a highway? Like there can be an accident on a highway that will cause a traffic jam. But most of the time, traffic develops spontaneously on a highway just as a function of the way that the network of cars operates.
Oh, that's exactly right. I mean, the shockwave theory was founded in, for explosions, detonations during World War II. But traffic jams and collisions are shockwaves. If one car has to brake very suddenly as it crashes into or it touches another car, the cars behind it also have to. And that creates a propagation effect, which is much worse than the actual event of one car banging into another.
So I don't know if you have anything to add to that, Ash. And then my follow-up question is, when we were talking about flows, have flows become more important in recent years than they used to be?
Well, I mean, yes and no, in terms of the flow question. The central bank clearly is more dominant than it was, and even simple metrics like the balance sheet are indicative of that, or the perception that the central bank is important, that's also indicative of that. It's also become increasingly clear with the explosion of listed derivatives like options that often flows in the option space, hedging flows driven by market makers, drive the underlying market. And we saw that with the meme stocks like GameStop and AMC and so on. And I think flows are more important, but they've always been important.
Are they also more important because it's been harder to generate alpha through traditional value analysis?
Yeah, I mean, this is something that Ash and I talk about and that Mike Green talks about a lot. And we both know Mike. And it's basically a paradigm whereby retail investors may chase performance. So they buy stuff that's done well, whether it's ARK or it's the S&P or it's the NASDAQ or whatever. And when they do that, the passive investments that track in various indices or that don't take strong views on valuation, they have to put dollars to work. And those dollars get put directly into the stocks that have done well. And that creates a kind of a positive feedback loop until one reaches a singularity where everyone's bought, everyone's over-levered, and a little bit of selling is going to create a negative shock to the downside.
Right, that's Mike's thesis. Do you guys think, where do you guys think we are in that if you ascribe to that view? Where do you think we are in that process? And is it possible to know with some degree of certainty how close we are, relatively speaking, based on the amount of passive that's been flowing into the market, the number of, the percentage of that passive that's going to go from being net buyers to being net sellers because of retirement ages? Like what's possible to understand there?
Yeah, this is a fantastic question, and it cuts to the core of the book of Market Tremors, which is that our goal was to take a lot of these ideas, whether it was Rick Buchstaber's idea about agent-based modeling or what the Bank of England did or what Doan Farmer has done at Oxford, and try and find concrete cases where we could calculate things, where we knew who the agents were, where we knew how large they were perhaps, or we could estimate that, how they would have to behave, what the impact of their behavior would be. And then we could use that to quantify risk. What Mike Green is doing is perhaps a broader and more lasting value, but it doesn't lead to quantitative estimates in the way that some of the examples that we produced did. And so I think that's not the edge, but that's the extra dimension that we added in the book.
And that's really the challenge, is finding those examples where you can know the size of the agents, know that the direction that they're going to have to move in and when, and then come out with a quantitative model, because these things can be happening beneath the surface all of the time. But unless you have those measurements of who the agents are and where they're going to be moving in terms of size, it's very difficult to come up with a quantitative impact model. And I think that's really one of Harry's major contributions here. In addition to developing the model, it's finding the data sets that will actually demonstrate that it is in fact true.
Walk me through some examples, guys. Like, what would be some really great applications of this model where you've got the data that you need to get the kinds of outcomes that you can feel confident about?
Sure. The main example in the book is the Volmageddon. That was a case in 2018 where VIX futures in the front month moved from about 15.6 to well over 30 in a single day, in the absence of any material external event, any exogenous news. Basically what happened was that there were two major inverse VIX futures exchange traded notes, or ETNs, that if they had tried to follow the benchmark that they were tracking, would have accounted for well over 30% of all the open interest in all the VIX futures. So we knew what the asset level was for those exchange traded notes. We knew what the prospectus said in terms of the benchmark and what it had to deliver. And so we knew that if the VIX went from a low level, let's say 15, which was roughly where it was, to 22, which is a pretty garden variety looking random shock, rebalancing would force a much larger move because they were so dominant. This goes back to Demetri's phrase, the dominant agents, in those markets, that the effect of their rebalancing would cause a much harder squeeze higher. And so we had various techniques that we used, and I'm grateful to other people who provided me with ways to do this. And so we estimated a follow-through based on a pretty normal-looking shock, exogenous shock, that would drive you well above 30, or at least a little bit above 30, near the close. And that's exactly what happened to the VIX during the Volmageddon. Basically what happened was people piled into strategies that were working extremely well for various reasons. Those strategies became bloated. And at that point, a modest-looking random shock forced such rebalancing that a tail event, or what appeared to be a tail event, essentially occurred. But it wasn't a tail event if you knew what the positioning was.
Yeah. And those strategies were also inherently short volatility, which had created this sort of feedback loop effect.
Right. And feedback is such an important part of this.
Yeah, I think that's right.
Yeah, feedback's massive. I mean, basically what the book is about is you have a historical distribution, you have a whale or a giant that has only so much pain they can take. They interact with the historical distribution, and if the distribution produces something moderately unpalatable, they have to liquidate. And the effect of liquidation drives the distribution in a whole new space. That's what the book is about.
So what are some good examples of that are more recent that maybe haven't blown up yet?
Oh, you're asking me to look into the future, but the central bank is the juggernaut all the time. Central bank is the dominant agent, the buyer of last resort, the dominant agent in markets as a whole at this point. So, if you look at central bank balance sheets and you try to relate them to the movements of risky assets such as corporate bonds and equities, you'll see a fairly strong, not super strong signal that shows the relationship between central bank policy and 1 to 2 year forward equity and credit moves. Other agents that dominate are options market makers. I sort of touched upon that with GameStop and AMC. The way they hedge, it's predictable, somewhat predictable. And also structured products, flow desks, and exchange traded products, flow desks.
With respect to central banks, I have a question, guys. So first of all, one question directly, which is that central banks aren't constrained in the same way that a private actor is constrained. They're effectively constrained by the value of the currency, which they conjure into existence in order to engage in open market operations if they feel that they need to. How do you think about those types of variables impacting the decision making of central banks when trying to think about the impact of such a dominant agent in the market?
Okay, that's a great question. Modern monetary theory has gained great currency recently. And as you say, central banks can expand the supply of credit as much as they want in a deflationary or a modestly inflationary environment. But they face two challenges. The first challenge is their currency going to be required for settling transactions? US dollar has been the de facto settlement currency for many years, as has, say, the Swiss franc and so on. The other question, though, which is perhaps more important than settlement, is inflation a risk? Otherwise they only have, it's a bit like a car that has to drive to the right of one boundary. It can always inflate enough. If the stability of asset prices is the only risk, they can always inflate enough to try at least to prevent that, at least given good enough sentiment. But if inflation becomes an issue, now you have a car that's moving somewhat wildly between two bounds, between a price instability bound and inflation gone wild bound. And that's where central bank policy becomes obvious that central bank policy is a blunt instrument.
Yeah. And to risk stating the obvious here, obviously, now that we're at about 8% on CPI, and it looks as though the Fed may have challenges on both sides of the dual mandate, obviously these compromises become significantly trickier to navigate.
So this kind of brings me to another question that I have in mind, which is that if we're on the cusp of a regime change, which is partly what your book attempts to try and anticipate, right? Or rather, the kind of risk modeling that you do, how do we know how to position ourselves if the risk-off collateral that we're used to relying on in order to hedge ourselves is itself part of what's changed in the new regime? That, in other words, if we have a sort of sovereign debt crisis of sorts that we're looking at here, or a currency crisis, or some situation in which Fed policy can't continue to be accommodative because inflation's gotten out of control, and there are doubts about the value of investing long-term in U.S. debt, how do you actually manage risk in anticipation of an event like that? It's almost like betting on a systemic credit crisis by buying insurance from the primary lenders against their own default. Like, how do you manage that?
I was talking to someone about this very recently, someone who knows more about it than I do, but usually you could do a lot of asset swaps, and the asset swaps market was and is very big and reliable, based on the idea that you could swap, say, even a long duration bond and receive the short-term interest rate plus, something for doing that swap. And if that collateral in a highly collateralized market environment is no longer accepted, I think we wind up with a revisitation of the post-2008 regime, which is that pre-2009, there was excessive lending, at least in retrospect, that led to a lot of collapses, bankruptcies, and the need for a bailout. And so one of the things that happened post-2008 was the requirement that a lot of the lending markets become collateralized. And now if this longer duration collateral becomes dubious, you got a lot of twists and turns in the plot.
Well, walk me through some of those twists and turns. And Ash, feel free to jump in here as well if you have any thoughts.
Well, what are the repo markets? You pledge a bond to a counterparty and you say that you'll buy it back at a higher price. Maybe in a day, maybe in a few days, whatever. It's the funding market. If that bond is no longer acceptable as collateral, or if it's perceived to have risk, then the short-term funding markets become more beholden to shorter dated debt. That reduces the supply of securities available to keep the whole thing going. And so, the whole move was good. It was kind of like, let's not lend just based on trust. Let's force the pledging of securities. But if these securities that have been pledged are suddenly perceived to be riskier by the marketplace than before, a huge chunk of the lending market collateral just goes away. I'm not saying that's what has happened, it is a risk.
Well, that brings me back to my original question, right? So what you're describing is a repricing of risk. Now, you have a lot of experience with trying to profit from risk repricing in options markets, Hari. But how do you profit from a repricing of risk in treasury securities when the primary driver of that risk repricing is the existential health of the balance sheet of the issuer of the prime collateral upon which the entire system is based?
Well, I don't want to say I'm a macro rates guy because I never have been. I have been a macro FX and certainly a volatility guy. But I do rates hedges, and I would simply say that if the perceived value of longer duration debt as collateral goes down, in my opinion, and it's debatable, the prices of these securities should go down too.
Yeah.
And if those prices go down, who knows what will happen?
Yeah, we have a little bit of experience with this with the 2007, 2008 financial crisis when we saw interbank lending breaking down, TED spreads blowing out, LIBOR, OIS blowing out. I'm curious actually to get maybe Harry's view on this, which is, how do safe haven assets in those circumstances behave? We even saw, I believe, deltas in pricing between on the run treasuries versus off the run treasuries, even on the relatively short dated side. So I'm curious about how you think about that in terms of treasury and dollar behavior when you have these interbank lending market breakdowns.
Oh, that's a toughie. What I will say is that one thing the second leg down tried to do was to say that it looked at stocks in one of the sections and it said, well, there are safe stocks and there are risky stocks. Safe stocks are stocks, to quote others, where if you bought what the company produces and it fell on your foot, that would hurt. Physical things, or, the Walmarts of the world, the Johnson and Johnsons of the world. And then there were risky stocks that, were more speculative, that had longer duration, at least in sort of in a discounted dividend model framework or whatever. And what I showed or tried to show or explain was that if things got bad enough, the stocks that were safe could get hit just as hard, if not harder, simply because people had unrealistic risk expectations of them in an Armageddon, in a really bad scenario. And that's kind of the theme that we looked at here as well, which is that sizing according to risk, sizing your positions actually is a source of instability, especially for stuff that's considered safe. Stuff like a pegged currency or a bond where the interest rate hasn't moved for ages. If you try and size it inversely proportional to its realized volatility, you can wind up in a world of trouble. And others will wind up in a world of trouble as well as they try and head for the exits at the same time.
Because you're positioning based on the historical performance of the asset.
Yeah, there's a whole world. There's an institutionalized, perhaps, world of sizing inversely to risk. Oh, the Swiss franc and euro have been moving in tandem. The volatility is very low. So let me take the extra yield from the euro, finance all of my activities in the euro. I know it's pretty stable, or at least I think it is based on the past, and capture the extra yield. That works until it doesn't. And, I think it was in 2011 that a lot of those things blew up.
Right. And I just want to also emphasize something that you're obviously aware of, but maybe listeners aren't. When you say size positions inversely to risk, what you really mean to say is size positions inversely to volatility, or to metrics of risk, not necessarily risk, because risk could be going up, but your models don't tell you that.
Yeah. Anything the whole point of the book is to say backward-looking estimates are not flawed. They're not completely flawed, but if you have a handle on the interaction between big agents or big problems and the historical distribution, you can do a lot better.
Yeah, I think another point in the book that's pretty prominent is the gap between the historical distribution and the single metric risk models that we've been talking about. The challenge is when you have a distribution that you're trying to infer sort of very stable risk parameters from, it's almost like a sampling issue. There's no way to capture the broader distribution in a single metric. And when you have people who are positioning very large institutional portfolios based on these single metric risk models or single metric risk overviews of what's happening, you wind up with a mismatch between what the actual historical performance or returns have been and what that single metric shows you.
Yeah, well, I mean, that's what I kind of liked about what you guys did in the book. And obviously there's so much of the book is just a lot of math that was over my head. But you kind of attempt to walk this middle path between a network model that is highly representative, but computationally impractical or infeasible, and a very simple model that doesn't accurately capture the complexities that drive market movements.
Yeah, I mean, there have been various novelists back in the day. Anthony Burgess is a good one, who would always write a hard first, second chapter to test the reader's commitment. That doesn't work in the modern age. You have to write something and deliver something that people can really dig into before you throw all the math at them. And that's what we try to do. I don't know what the proper blend is, but that's what we attempted to do.
So guys, I want to give you guys a chance to share any other thoughts you have about the book, about the lessons that you want to impart from it. And if you want, I'm very happy to talk more about where you guys think we are in terms of the market cycle and what some of the most important risk factors are that people should be paying attention to. It's kind of outside of the scope of the book, but we can have that conversation as well. But please go ahead and give me your thoughts.
Well, we actually opened the book by talking about the zombification of markets, which comes down to the 2 points that we mapped out at the beginning: excessive debt flowing throughout the system and central bank policy that has remained ultra accommodative for an extremely long period of time. And I think that it's fair to say that both of those macro backdrop effects are still very much in play as we record here in March of 2022.
I mean, I think the main thing now is just the central bank as a dominant agent, the rise of passive, and the chasing of returns in various spaces. I think the chasing of returns that part of the cycle is pretty much over. I mean, the tech area has been relatively volatile. The risk-on proxies, which are basically the things that have worked well recently, have been bouncy with trend to the downside, stuff like crypto.
Growth stocks.
Yeah. And the end game, in my view, is not rotation anymore. It's not rotation from growth to value. It's rotation from growth to let's get out of everything. And that is a function of the highly levered system that we live in. Back in the day, if there were no drastic changes in leverage, then growth to value would be a risk on, risk off kind of safety valve that people could go into. But I don't think we're in that space anymore. I think we're in a space where it's even safe looking equities are still risk on investments. And it's more extreme than that. I think the barbelling is more extreme than it used to be.
All right, walk me through that. If we go from not from growth to value, but from growth to get out of everything, what does that look like? What does get out of everything into what? Into cash?
Yeah, I mean, that's the crucial question, because people talk about risky and safe stocks, right? Growth and value. And value stocks maybe have bigger earnings, realized earnings. Maybe they pay bigger dividends, so their multiples are lower, however you define them. But still, if you think of risk not only in terms of volatility, but in terms of duration, what's the duration of these things? I don't know what the duration of a highly speculative tech stock that invests all of its earnings back into itself is. I don't even know what a growth stock's duration is. Any attempt to try and measure that is deeply uncertain. And now, if you go into a scenario where 10-year treasury notes or 20-year treasury notes are risky, what does that say even about value stocks?
Because it eats into all of the duration, is your point, especially for growth stocks. They're so dependent on liquidity.
Exactly. And duration ultimately is the driver of many institutional allocations. Do pensions think in terms of volatility or duration? Well, they might say they think in terms of volatility, and maybe they do. Maybe they measure that. But really, it's the duration of their liabilities that they have to worry about.
Well, that goes back to my question, though, that I asked like a few questions back, right? Which is that normally in risk-off events, you see people fly to treasuries. You see people fly to cash. If the value of that so-called risk-off asset comes into question, and we're not sure how to value that sort of basic risk-off exposure, where does that leave us? Because it feels like that's kind of what the end game is, whether it's today, tomorrow, some future date. It feels like that's where we're moving towards, where more and more people question the safety of that, for lack of a better word, prime collateral or sort of base money.
Well, it's going to be a highly interactive, complex system where if the prime brokers lose faith in it, game's over, basically. Now, I would find it hard to think that T-bills or short-term cash deposits would be unsafe. But if longer duration securities are, that has some impact on the entire lending system. I kind of pointed to that before when I talked about the highly collateralized lending system that exists in today's markets.
So then how do we think about agent-based modeling in these network-based simulations or models?
It's all about the plumbing of the system, right? The plumbing of the system. People like Warren Mosler talk about this in terms of the central bank or in terms of how they change reserves on their balance sheet and how that at least encourages lending within the system. This is all about plumbing. And one of the reasons that market makers or people with market making backgrounds like Jem Karsan and various others have had a big voice recently is because they understand a lot of that plumbing. They know how, maybe not plumbing for this word, but they understand a lot of the technical details that drive price moves. And a big example that we didn't allude to in the book, but is highly derivative from the book, is these meme stocks, which I mentioned, where they blew up outside of all proportion because retail investors and other small investors were able to buy enough out of the money insurance claims where they would make a huge amount, out of the money call options, where they'd make a huge amount if the prices went up enough, that the market makers were forced to buy the stock to protect themselves against the options they had sold. And so that's really a major point. I mean, the book is not intended to be very theoretical. It's intended to describe a paradigm that is increasingly important in markets and to redress a misunderstanding about markets being driven by external news instead of focusing upon the needs, the requirements of the players in the market that drive flows.
Yeah, and one of the factors that I think is definitely related to that is the extent to which derivatives markets, options and futures have an impact on the underlying price of the assets themselves. And Harry is probably the better person to talk about this. But Harry, could you talk a little bit about how large banks, for example, have to delta hedge their portfolios and what happens in the event of a gamma squeeze? Because I think that's incredibly relevant to the point that you were just making about GameStop.
Yeah, I mean, the phrases even go over my head. But basically, banks are intermediaries more than they used to be. And that doesn't matter whether it's corporate bonds or options or anything. But let's focus on options for a moment. So customers want to buy, let's pick a market like the S&P 500. Institutions like to buy put options to hedge. They're worried about extreme downside scenarios, especially now. And maybe they like to sell call options for income. So they collar their trade. In other words, they make money if indices go up. They lose money if indices go down, but they don't lose that much if indices crash. And so they have this kind of more defined payout profile that is supplied to them by banks, market makers, whatever you call it, flow desks. Those flow desks don't have big balance sheets, at least the departments don't. So if they're short a put, which means they're selling insurance against an S&P collapse, if the S&P starts going down, they have to sell futures to hedge those puts. And that can have an impact on the underlying price action. If nobody else knows what to do, no one else has a strong view, if there's no absorption of price movements, they go in and they kind of define the price via flows. And there's been a lot of interesting research that others have done. I have to confess I don't know it that well, but Ralph Koergen and Xavier Gabay have done a lot of work on the inelastic market hypothesis, which suggests that prices don't adjust purely as a function of new knowledge, but as a function of flows.
So where does that leave an investor like me, right? Because it feels like so many of these strategies are not accessible to me. So what do? Do I just end up going into the ETFs, which Mike Green says eventually are going to lead to sort of wholesale slaughter? What do most people hearing this do, right? Because like I said, it used to be you just buy index funds. But if we acknowledge that, if we're able to sort of wrap our heads around the idea that index investing is itself perilous, because eventually the flows that were driving the price up are going to start driving the price down, what does a normal person do?
Let's take the Mike Green paradigm for what it's worth. And I think there's a lot of truth to it. And I think he's been one of the best to articulate this. But Mike Green paradigm is that when there aren't many active investors who look for value, active managers who look for value, prices tend to have stronger positive momentum but larger tail risk. Let's say that's true. I think that probably is true. It means that you should chase returns, perhaps, because there will be momentum, but don't chase them as hard as standard portfolio theories would suggest you should, because the left tail increases as more and more people chase the same trade.
But how do you know how far along in the trade you are? I mean, that your positioning depends on where you are in that entire duration.
You don't know. You don't know exactly. I can't give you a prescription there. What I can say is that if something has been rallying for a long time, don't try and fade it. Don't try and trade against it because it's a bubble, because bubbles can go on for a long time. But don't size it in the way that standard portfolio theory would. Find something that's a little bit less popular and do a bit more.
That's what I did in 2017, Harry. It didn't work so well for me.
Well, this is no. I mean, I'll push back on that one, Demetri, because standard prescriptions are always going to have weaknesses, right? You can always find cases where they don't work. What I would say though is you don't want to short the meme stocks. Neither do you want to push too hard on them, because that's a violation of, if you even believe portfolio theory is vaguely relevant, you want to be careful about sizing according to volatility for stuff that's really popular. Mm-hmm. Now, I agree with you, though. I mean, this is not the be-all and end-all. Market Tremors is not a guidebook to success in the markets. It's a roadmap for trying to identify situations where the market hasn't realized the danger in price action terms, but where positioning or leverage risk is high.
Yeah, and I agree. And I think actually, when I have conversations with guys like you, with Mike, Eric Peters, and others, what I come away with is, wow, okay, this is why I shouldn't try to compete with these guys in the market, because these folks are able to understand the drivers of market movements in ways that I can't. And because the sort of basic value models that most investors felt comfortable relying on to make discretionary market decisions, if they didn't want to just be invested in index funds, haven't worked. And there's just been a lot of doubt about them. So that, I think, I just wanted to try and speak to that paradox, so to speak.
I think the investor who isn't Mike Green or me or whomever shouldn't despair, because none of us know everything. And all of us are trying to exploit the edges we may have, that we believe we have, and immunize ourselves somewhat against everything else. That's what hedging is, basically. That's what spread trading is. That's what portfolio management is. We don't know everything. I mean, if you ask me to talk about the current situation in the Ukraine, my opinion is of no more value than anyone else's. The only difference is I know that. Maybe there are other things I do where I don't know, or maybe I do know. But I'm trying to exploit my
that's half
edges.
the battle.
And
knowing what you don't know.
Yeah, being careful about, what's that equation, Ash? It's like your favorite equation, the Dunning-Kruger.
Dunning-Kruger effect, indeed.
Yeah, that's your favorite.
Yeah. Essentially, the more ill-informed you are about a particular area, the more sort of dangerously irrational your decision-making can become, because you don't have the context to understand that your decision-making isn't very good. Look, I would say more broadly, it's always challenging when you have a sort of a highly theoretical book to come up with a practical takeaway. But I think it's probably reasonable to say, be careful. There are factors lurking beneath the surface that are very difficult to measure. And there are, particularly around risk metrics, some potential distortions that may lull people into a false sense of security about the potential future volatility of an asset or asset class based on the past distribution of past returns. And so be very careful when you think about those numbers if you're using that from a risk modeling perspective, because some of these endogenous factors with regard to market positioning, credit risk, don't always show up, particularly on shorter time horizons. And so be careful when you think about that.
Yeah, I mean, what I would say is that distinguish between FOMO and trend following. This is very important to me, which is that don't feel, oh, the guy down the street, he's making a ton of money on crypto, some cryptocurrency, so I need to get in. If you're systematic and you try and follow the trends, even without too much regard for value, and you have decent risk management techniques, you'll be fine. I would hope you'll be fine. The danger is chasing moves in an undisciplined way. Whether they are flow-based or valuation-based, it doesn't matter. But trend following is not a bad thing. In fact, I think it's a very good thing because sometimes moves via feedback loops, via leveraged induced feedback loops, go a lot further than people think. And so just cutting your gains too quickly is not a great idea. But don't do it in an undisciplined way. Don't chase stuff that your neighbor says is working or that someone else says is working just because you're afraid of missing out, because that's not going to work. The feedback loop idea, where there are positive and negative feedback loop cycles, probably does work. I won't say anything definitive, but the book is basically trying to tell you that.
And my closing thoughts on this are, Hari, having read your first book as well, one of the things I love about both of them is there's a kind of wisdom that comes out of your work, out of your writing, and there's a sort of philosophical approach to markets that I really value. And so, again, it's a phenomenal book, and I highly recommend it, and The Second Leg Down. And thank you guys for coming on the podcast today.
It's our pleasure.
Thanks for having us, Demetri.
For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.